the solar industry as well. So with that, let me hand it over to Shayle to talk about the U.S. solar market.
All right, great. Thanks, Scott. And it's exciting to be here. It's a great turnout. It's obviously an extraordinarily interesting time to be talking about the U.S. market. So we have a lot to talk about over the next couple of days. And my idea here is to kind of set the stage, talk a little bit about what's been going on in the U.S. market, some of the major trends, and really raise some questions that hopefully will be answered on the panels over the next couple of days. Today is day 67 AS, which stands for after Solyndra, which is how I think about the world now. I think it's kind of extraordinary that it's only been 67 days since Solyndra announced that it was filing for bankruptcy, because it feels like, if you've been in the solar industry since then, it feels like it's been a long time. We've had a lot happen. So let me just dive right into it. Let's start with the broad picture that everyone probably knows. 2011 has been a very difficult year for manufacturers of solar across the value chain and across the globe. We had a situation where manufacturing capacity for PV modules looks like it's going to grow something like 55% year over year from 2010 to 2011 at year end. And at the same time, demand on a global scale, depending on how Q4 turns out, primarily in Germany, looks like it's going to grow somewhere in the 10 to 15% range. So we obviously had a mismatch there, and that exacerbated what was already going to be somewhat of a structural overcapacity, and so prices began to plummet back in around May and haven't really let up. We've seen prices falling, continually on a daily, weekly basis since then. No real stability yet, and so we're looking at something like a 40% decline in crystalline silicon module prices over the course of this year so far. And again, this is a moving target, but that's been hard on every manufacturer. Margins are getting hit. Some manufacturers are idling lines, they're changing their capacity expansion strategies, and they're trying to figure out what's next. But the topic of this conference is the US market. And the fallout from basically what's been happening on a global scale in the US has been particularly strong and somewhat of a surprise. And so just to recap, we've had 3 bankruptcies of US solar manufacturers this year. Solyndra is obviously the most well-known, but Evergreen and SpectraWatt shouldn't be forgotten about. We've also had 3 plant closures, one from Solon and one from SolarWorld that are permanent. Unisolar announced just last week a theoretically temporary shutdown. So 3 bankruptcies, 3 plant closures, and then this enormous media reaction primarily to Solyndra. And I think we're at the point now where Solyndra is actually a household name in the US, which is really unfortunate for the solar industry here, that's how it had to happen. But it has elevated solar to this new stage where it's in the media a lot more than it ever was before. And I think previously we were relatively blessed in the fact that solar almost exclusively had positive press, and now we have to deal with negative press in the US on a large scale for the first time. And so that's something we're dealing with now. And then finally, a topic which I'm certain is going to permeate the discussions throughout the next couple of days. We have this petition that was filed by SolarWorld and the Coalition for American Solar Manufacturing last month that is, just to recap for anyone who hasn't been paying attention, is an anti-dumping countervailing duty petition in front of the International Trade Commission and the Department of Commerce in the US that alleges that Chinese crystalline silicon cell and module manufacturers have benefited from illegal subsidies from the Chinese government and have been dumping product into the US. So that is obviously a topic that is in extraordinary amount of flux right now. It still remains to be seen how this is going to play out, but there are a lot of questions to be raised about what the impacts of that will be near term, what they could be longer term, and how we can deal with it as members of the US solar industry. So it's not my position to assess the likelihood of any given scenario playing out, but I did think it would be worthwhile to take a look at what some of the market impacts could be near term and longer term. So starting with this, let's assume that there's a possibility that you will have an import duty placed on Chinese cells and modules sometime next year. what impact would that have on the market? How much of the market did they comprise? So we took data from California, New Jersey, and Maryland, which admittedly is not the entire market, but it is about 55% of it the past couple of quarters. And we looked at the headquarters of the manufacturer that installed those modules. So this is not the location of manufacturing of the panels. And I should be clear on that because, for example, SunTech, which has a manufacturing facility in Arizona, would be classified here as Chinese because the company is headquartered in China. Given that, we see that Chinese market share in the US has grown relatively meaningfully over the past year and a half. This is looking at the beginning of 2010 to Q3 2011, from 30%, which was actually a jump, kind of an anomalous quarter in Q1 2010. So it's really more like the low 20s up to about 40% in the residential and commercial markets in Q3 of this year. In the utility market, which is not included here for two reasons. One is that we have an entire afternoon to talk about the utility market tomorrow, so I'll leave it for that. The other is that if you look at utility installations, it's kind of a misleading story. It would make more sense to look at the utility pipeline because the utility market is still so nascent in the US. That said, if you were to look at utility installations, the numbers are actually relatively similar. We've been seeing Chinese modules comprise somewhere between 35 and 40% of completed installations in the utility segment. So this is the overall story. Another way to look at that is to see who the largest suppliers are, or who are the leading suppliers in terms of market share. So this is taking that same data set and breaking it up by leading suppliers in 2010 and then comparing that to 2011 through the third quarter. So in 2010, we had one Chinese supplier that showed up in the top 6, and then a bunch in the other suppliers category there. SunTech held third position there. By 2011, a relatively short period of time, we've now got 3 Chinese suppliers in the top 4. So broadly speaking, the point that I wanted to make here is that we do have, and I think there's another point to make that this is looking at completed installations. If you actually look at it on the flip side of the project pipeline, the numbers are going to be even higher for Chinese suppliers. At least they would have been. So the point generally that I want to make here is that there is a substantial impact that this would have on the market. And so what we need to be talking about over the next couple of days is how do we deal with that now? What kind of uncertainty is out there? What should procurement strategies be in the meantime? How should we be looking at this longer term? So with that, let me raise a few questions, and then I'll move beyond the trade issue. Because I do think right now we're still at a point where we're raising questions. We're not answering them yet. First of all, I think there's an interesting question that this has brought about with regard to timing of shipments. So there was an expectation that we would see a boom in shipments into the U.S. market in the fourth quarter of this year as a result of projects wanting to safe harbor panels for qualification for Section 1603 Treasury grant, assuming that it's not extended. And I think people, whether or not it ultimately is extended, which is always a possibility, people are currently planning assuming that it's not going to be. So given that, there was this expectation that people would be shipping a fair amount of modules. This happened last year, and I think it was going to happen even more this year. But you don't actually need to ship the panels to qualify for the cash grant. You just need to take ownership of them. And so we'd been having discussions with some developers that were planning to take ownership of panels that would remain in China at least through the end of this year. But now there's this question of import duties. What happens if the import duties are imposed retroactively back to the beginning of the year, back to the date of the petition? It's all possible, albeit not particularly likely that it would go back to the beginning of the petition. But there is some risk there. So how are developers dealing with that risk? How is that changing procurement patterns in Q4 of this year? And then how is that going to relate to installation numbers throughout 2012? What is that going to mean for this Q4 shipment boom? There's another question, which is that if some developers are deciding that they can't take on the risk of import duties for shipments either late this year or early next year, and they're looking at switching their supplier for a given project, what does that mean for that project, particularly if it's in the later stages? If you have arranged debt, do you have to unzip and rezip the debt with a brand new module supplier? Do you have to redesign the system, re-engineer it? What is that going to mean for these project timelines? And then finally, another question that I think is worth asking is the import duty is assessed, if there is one put in place, it's assessed on the importer of record, whoever imports the panels or the cells. So who's going to take on that risk? You could have a situation in which suppliers ship the product themselves into a warehouse that they hold in the US. They become the importer of record and they take on that risk and offer fixed pricing to their customers. I don't know to what extent that is happening now or will happen, but it's going to be an interesting dynamic to see who's actually importing these panels in the interim. I guess one point that I should make here is that these questions that I'm raising, these are short-term questions. These are things that we have to deal with over the next 3-4 months until we have a preliminary finding that would determine whether import duties begin to be assessed. After that happens, there's a completely different dynamic that I haven't even talked about. So let me set that aside for now, and I'm certain that there's going to be plenty of discussion around this issue over the next couple of days. But I do think it's also worth stepping aside from that and looking at some of the broad trends in the U.S. market. Many of you have probably seen this before, but the U.S. market from a global scale has historically actually been pretty consistent, oscillating somewhere between 5 and 7% of global installations in any given year. So while those of us that have been in the U.S. market have been seeing it grow year over year, it's actually been more or less in tandem with the growth of the global market, which has kept the U.S. in 3rd or 4th position generally in any given year in terms of total installations. So it's been an important market, but it hasn't been the most important market. And 2011 is undoubtedly a year in which that's changing very quickly. We have the U.S. market, which looks like it's probably not quite going to double, but going to come close, in contrast to a global market, which, as I said, looks like it's going to grow 10 or 15%. So U.S. market share is growing this year, and I think by all expectations, it's going to continue to grow over the next few years. And this has played out because we've seen manufacturers, we've seen developers, financiers, companies that have been active in European markets for years and never really had a presence in the U.S., investing in developing a growth strategy into the U.S. market in droves over the past year or so. I think it's generally understood that the U.S. is one of, if not the most important growth market for PV for the next 4 or 5 years, for the foreseeable future, really. And that means there's a lot of activity here. There's a lot going on. There's a lot of changes in terms of business models, in terms of where the growth is coming from. So let me see if I can highlight a bit of that. And again, I'm going to set utility scale aside because we have an afternoon on that tomorrow. First of all, where is demand happening? I think the title of my presentation in your agendas is 50 states, 50 markets. That's because the U.S. market as a single entity doesn't exist. It's really a state-by-state demand center. Everything is driven at the state level. In some cases, it's even driven at the utility level. And so one of the most important dynamics that we can monitor is geographic diversification of the market. To what extent are we actually seeing a true PV market or a solar market in more states? Because ultimately the value of the U.S. market lies in there being 50 states, and 50 states, each of which has some meaningful amount of solar demand. So let's look back for a second. In 2007, we had 4 states, each of which installed over 10 megawatts individually. That's actually a bit misleading because Nevada and Colorado each had a single utility scale installation that drove the vast majority of that 10 megawatts. So set those aside, and in 2007, we really had 2 markets, California and New Jersey. This is what it looks like it's going to be for 2011, depending on how Q4 plays out. We're probably going to be at about 17 states that have done the same thing. We'll have probably 5 states that do 50 megawatts or more, and we'll have at least 2 states, maybe 3, that do over 100 megawatts. So we've come a long way. You know, we have 16 or 17 state markets that are of a meaningful size. But we were at 16 states in 2010. So geographic diversification has come a long way, but is not rapidly expanding just yet. And there are a lot of states that are kind of waiting in the wings that could pick up a meaningful amount of demand. And we have a session on that today, identifying the next state growth market. That's an important thing to be doing in the U.S. because it's a benefit. In contrast to, say, Germany, a feed-in tariff market where one change to the single federal incentive program can make or break the market, we don't really have that in the U.S. At the state level, you can get rid of one incentive, and then another state may pick up. And so it allows us a bit more flexibility and less dependence on single incentive programs. So the latest report that we released with SEIA, the Solar Market Insight Report, was the second quarter. But we do have preliminary numbers on the third quarter. We'll be releasing that report in about 3 weeks, but I thought I would share some preliminary numbers with you now. It looks like we installed about 450 megawatts in the third quarter in the US. That is by far the biggest quarter that we've ever had. The second is Q4 2010, when it was about 361 megawatts. So that's big growth. But that does mask the fact that on a market segment by market segment basis, things differ a little bit. The bottom bar there is residential. The residential market has actually been the most steady on a national basis for the past couple of years. It hasn't been growing by leaps and bounds, but it also hasn't been falling in any given quarter by any meaningful amount. We did see some growth in Q3 of this year, and I'll talk in a minute about, I think, what the major trends are there. The commercial market, as I'll discuss in just a second, has been the most volatile, and that is where we saw the market actually shrinking in Q3 by a pretty fair margin relative to Q2. And the reason for that is that the three largest commercial markets all shrank in Q3, and I'll talk about that. And then finally, the utility market is really where we saw this growth. We saw over 200 megawatts of utility PV, which by our definition is PV installed on the utility side of the meter, regardless of the size of the project. We saw over 200 megawatts of that connected in Q3, and there's another 700 megawatts or so that are in construction that initially were planning to be completed in 2011. So a lot of the overall numbers for 2011 are going to be determined by construction timelines on these projects. But we anticipate another 400 megawatts or so coming online by the end of this year of utility PV. So that's going to be important when we look at the overall numbers. I think people at the beginning of this year were calling for 2 gigawatts. We were calling for 1.8 this year. We're going to revise it downward just slightly, I think, to around 1.7. But again, a fair amount of that is dependent on utility projects getting completed. Just a couple of overall trends, one for the commercial market and then one for the residential market. As I said before, the commercial market shrank in Q3. And so it's worth diving into that a little bit because it's kind of counterintuitive if you consider that everyone is expecting the US market to be growing every quarter. Really what's happening is that we had three markets that were the three largest commercial markets, and for different reasons, all three of them fell a bit, or a lot, depending, in Q3. In California, which is the topic of the next session that we'll have immediately after this one, we have had the California Solar Initiative PBI frozen in 2 of the 3 utility territories for the better part of this year, and so that really started to hit installations in Q3 more than it had before. In New Jersey and Pennsylvania, we have SREC markets that are in oversupply, and so we had SREC prices in Pennsylvania drop to $10 on spot. In New Jersey, they dropped from what had historically been up around 600 down to below 200 and then bounced back up a bit. And we have a session a bit later this morning with an absolutely world-class panel of experts on SREC markets, so stick around for that one. So we'll get into a lot more detail there. But the other point here is that the rest of the U.S. actually fell just a little bit too, and that's a trend that we want to be monitoring very closely because I think California will turn around. It's a question of when. New Jersey and Pennsylvania, it's a bigger question. We have an oversupply in the SREC markets that will last an undefined period of time, and that's something that I think will be discussed later this morning. But we really want to see growth in the rest of the U.S. We want to see markets like Colorado, Arizona, Massachusetts, Maryland. These are all states that could be seeing commercial market growth, and we expect to see it starting next quarter. In the residential market, the biggest story of the past couple of years has been the growth of third-party ownership. I think that's probably no surprise to anybody. We saw back in 2009, it was really a nascent idea. We had seen it in the commercial market since 2005 or so when companies like SunEdison pioneered it. And companies like SolarCity, Sunrun, Sungevity pioneered this in the residential market beginning early in 2009 in any meaningful volumes. But it used to be just a few players in that game. And that's been changing. By our count, there are about 17 companies now that offer residential solar leases of one kind or another. And there's a bunch of different business models that have built up around that. You have the third-party finance providers that don't actually do the installation themselves, but they sit on top of installers and provide the financing and the lease option, Sunrun being the biggest example of that. You have the kind of hybrid, which is the finance provider that does sign up deals themselves, but doesn't have a team of full-time installers on staff. Instead, they subcontract installations. So Sungevity is your example there. And then you have those that are integrators as well. They sign up the deals, they do the installation, they do the financing, all in-house, and SolarCity is the biggest example. And then now you have module suppliers that are also offering residential lease programs. And this is an interesting trend where, as part of their dealer networks, as part of the value that they provide to their customers, they are offering residential leases. And the companies that have been pioneering this are generally those that have the most built-out, highest level of service dealer networks in the U.S. SunPower is probably the biggest example of that, but SolarWorld is another one, and SunTech now has a residential lease. So these are a bunch of different business models leading to the same thing, but the big point that I wanted to make is that the residential leasing model is relatively heavily dependent on tax equity. And so what we're going to be watching over the next couple of years, particularly if 1603 isn't extended, is who's providing tax equity for these residential leasing programs. Thus far, we've had, by our count, 6 tax equity providers for residential leasing, and various iterations of that, various combinations of the tax equity providers and the lease providers. But we need more of that. If that business model is going to scale, we're going to need to see more entrants in that tax equity game. And that is a conversation, I think, for this afternoon on one of the financing panels. So one of the big questions that we have to face then here, because we are, I think, 7 weeks out from the end of the year, is what is the U.S. market going to look like in 2012? How big will it be, and what's driving that? And to be honest with you, we track the U.S. market extraordinarily closely, and even we have a hard time figuring out exactly what's going to happen next year, because there are a bunch of factors that are in flux that can determine whether the U.S. market it'll grow, but whether it grows a lot or grows a little. And so I thought, rather than just telling you a number, I would run you through what I think are some of the really key factors that are going to determine the size of the U.S. market next year, the amount of growth that we see. So generally, we break them up into 3 categories. There's pricing, there's financing, and then there's state market dynamics. Within pricing, the biggest question here is, what does the global picture look like? If we end up in a situation where the global oversupply continues, continued shakeout of suppliers, global demand doesn't pick up all that much, module prices continue to fall, that's obviously a positive thing in terms of installation growth in the U.S. If, on the other hand, and I think this is a less likely situation, if you ended up with an accelerated shakeout and then oversupply kind of ended, module prices stabilized early next year, and we stopped seeing that decline, then the U.S. market growth would be a little bit less. As I said, I think that's a less likely situation. The question is more, how far can module prices fall? And again, that's a question for tomorrow morning. Second, we have the possibility of an import duty on Chinese cells and modules. What impact would that have? How big would that duty be? Would that effectively shut Chinese suppliers out of the market, at least temporarily? And if not, what difference would it make in terms of overall pricing? There's an open question there that is going to be playing out over the next 12 months, and there's really no answers yet. In terms of project finance, the biggest thing that we could do to help the U.S. market is extend 1603. That immediately would alleviate what's likely to be a tax equity bottleneck next year and enable project financing to continue to grow. Assuming that doesn't happen, then the big question is, what does the supply of tax equity look like? Will we see expected yields from tax equity suppliers increasing? What's that going to do to project economics? At the same time, will we see new entrants in the tax equity game? We've seen a little bit of this. Apart from the historical tax equity providers, which are the big investment banks, we've seen Google, we've seen PG&E providing tax equity for solar. It looks like Chevron might do it. That's a positive sign, but there's a lot more of that could be done. And I know that the companies that have been raising tax equity are having those conversations. So there's a question for 2012. And then finally, state market dynamics. This one, in my mind, is by far the most important. As I said, everything in the U.S. is driven at the state level. And so the question is, in any given state, what's going to happen? There's legislation that could help or hurt the market. We have the New York Solar Jobs Act that could make a huge difference in the New York market, create another New Jersey within the course of a year or so. We have legislation on the docket in New Jersey and Pennsylvania that would help alleviate the oversupply of SRECs that we see now. There's been, on the negative side, some conversations in a few state markets about rolling back RPSs and things like that. So there's offense and defense to be played in terms of state markets. Apart from that, I think there's also a question of when will we see new states pick up? As I said before, geographic diversification is key. And what we really want to see is a bunch of new states implementing demand programs of one kind or another. And so we're watching out for that in places like Texas, Missouri, Illinois, Puerto Rico, which is a surprisingly big market already. These things together are all worth watching out for because every single one of them can have a significant impact on demand growth next year. And so, I think these are all questions that we can address in the various themes in this conference. Finally, I like to put this slide up at the end of presentations on the U.S. market. These are the 10 largest individual power plants in the U.S., primarily hydro and nuclear, as compared to cumulative PV installed as of the end of the third quarter. And for those of you that are going to catch me on it, this does not incorporate capacity factors, so it actually even looks a little worse for PV, which basically says that to date in the U.S., we've installed one large power plant's worth of PV, which means we have a long way to go before we are a substantial part of the electricity portfolio in the U.S. But it also means that the bounds for growth in solar are not even within sight yet. We talk about a doubling from 800 megawatts, 900 megawatts last year to 1.6 gigawatts this year. This is nothing compared to what we could be seeing 5-10 years from now. And so that's why the U.S. market is exciting. But at the same time, we have to deal with business on a day-to-day, month-to-month basis. And there is an extraordinary amount of volatility that's going on within that right now. And that's why I think this is going to be a great conference, because we have a speaker lineup that should at least help to answer a few of these questions. So with that, thank you. And I think we have time for a few questions if there are any. And I think somebody has a mic if there are any questions. Please.
You suggested that it was possible that Section 1603 could be extended, and I guess I've been on the pessimistic side of that analysis. What are your thoughts on a scenario that could result in an extension?
That's a good question, and I'm not active in Washington, so I can't speak to this scenario specifically, but I will say that we have Ron Resch, the president and CEO of SEIA, who's going to be on a panel later this morning, who's obviously on the front lines of that discussion, so that's a question that we should definitely ask. Any others? Please, Travis.
So what we keep waiting for as we get nearer or beyond grid parity in some markets, however you measure that, is some form of price responsiveness where lowering prices actually can stimulate demand. Germany does this very well because they have an infrastructure that can respond to lower prices, and which drives up the cost of capital. Where do you see the most price responsive parts of the market growing in the U.S.? Because that's clearly where the opportunity is going to be as prices come down.
Yeah, I mean, I think, that gets at the question of price elasticity of demand in the U.S., which has always been really tough to figure out, to be honest. In any given state, it's different from others. And there's also these other factors in the U.S. that make a big difference. Like if you have a rebate market, so much of the growth is dependent on the amount of rebate funding that's available. And so you take that away, and then there's a whole separate level of price responsiveness. I think SREC markets are where you'll see that the most immediately, because they are market-based mechanisms. That, or places where you start to see installations going in outside of state-level programs. California is going to be the best example of that. And then on the next panel, this is a question that I have. Let's say you take the California Solar Initiative away. We're now getting to that point in California where you can do some installations. You can make the economics work for projects without the CSI, just using the ITC and accelerated depreciation. So there's when you would expect price elasticity to pick up. But, honestly, I don't have a great answer for that, because I think it's always been really tough to call how price responsive the markets will be in the U.S. once you remove all these sort of other extraneous factors. All right. If there are no other questions, then we're going to go right into the next session, which is on the California market. So if I could have the panel